Good day, ma'am. I am going to report about the 5 Cs of credit. What is a credit scoring system? What does 5 Cs of credit mean? 5 Cs of credit mean a method used by lenders to determine the credit worthiness of potential borrowers. The system weighs 5 characteristics of the borrower, attempting to gauge the chance of default. The 5 Cs of credit are character, capacity, capital, collateral, and credit history. First is character. Will you repay the loan? The first factor is character, which refers to a borrower's reputation. Sample questions. How long have you lived at your present address? How long have you held your current job? Next is capacity. Do you have the ability to repay a loan? Banks compare income against requiring debts. Sample questions. What is your salary? What are your current debts? Next is capital. What are your assets and net worth? The lenders will consider any capital the borrower puts towards a potential investment because a large contribution by the borrower will lessen the chance of default. Sample questions. What are your assets? What are your liabilities? Next is collateral. What if you don't repay the loan? Collateral, such as property or large assets, help to secure the loan. If you fail to repay the loan, the creditor may take whatever you pledge as collateral. Sample questions. What do you have to secure the loan? A vehicle, a home, or a furniture? Next is credit history. What is your credit history? The conditions of the loan, such as the interest rate and amount of principal, will influence the lender's desire to finance the borrowers, depending on credit history. Example questions. Do you pay your bills on time? Have you ever filed your bankruptcy? Next is, what is a credit scoring system? Credit scoring system, lenders use a credit scoring system or a numerical system to measure how likely it is that a borrower will make payments on the money he or she borrows. It is created by assigning scores to various attributes associated with the applicant's credit worthiness. Uses of credit scoring. Lenders, such as banks and credit card companies, use credit scores to evaluate the potential risk posed by lending money to consumers and to mitigate losses due to bad debts. Lenders use credit scores to determine who qualifies for a loan, at what interest rate, and what credit limits. Lenders also use credit scores to determine which customers are likely to bring in the most revenue. Credit scoring is not limited to banks. Other organizations, such as mobile phone companies, insurance companies, landlord, and government departments employ the same techniques. Some facts about credit scoring. The use of credit or identity scoring prior to authorizing access or granting credit is an implementation of a trusted system. Credit scoring also has a lot of overlap with data mining, which uses many similar techniques. Next is 5 Cs of borrowers in credit scoring. Character measures the borrower's character and integrity, reputation, and honesty. Capital measures the difference between the borrower's assets, such as car, house, and liabilities, which is renting expenses. Collateral measures the collateral provided in case payment problems occur, such as house or car. Capacity measures the borrower's ability to pay, job status, and income. Next is condition. Measures the borrower's circumstances, market conditions, competitive pressure, and sessional character. As you can see here are the simple example of credit scoring. Example applications: scorecard. A customer with age of 35 income of 12,000 and residential status with parents is assigned a total score of 120 plus 140 plus 70 equals 330 points. Next, as you can see here are the credit scoring at different stages. Next is marketing score, 4 P's. First is product. Specifications of the offered services and their correspondence with the potential customer's needs. Pricing, price setting, including promotions, discounts. Next is promotion. Advertising, publicity, personal selling, brand products, and company recognition. Last is place. The channel via which the banking products or services are sold. Density of a retail network, internet banking, specificity of the customer group. It may also refer to placement, the physical distribution to the customer. Next is application scoring. Application score system. A. In full automated application score systems, the application is approved if the score exceeds the threshold value or cutoff. B. In semi-automated system, the application is automatically approved or declined for high and low scores. For intermediate scores, the decision follows from an additional human expert analysis. Next is type of scoring. Targeted scoring, internal and external scoring, counterparty and facility scoring. That would be all. Thank you.